everybody. Welcome to Friday, another Talk Money with Tom show today, coming live from Silicon Valley. Really looking forward to today's show. This is about retirement, specifically the financial portion of retirement, and we try to help people, either get ready for retirement or if they're already in retirement, improve their self financially. We look at, how to manage the money, right? How to manage the taxes long term, and the planning aspect of retirement also. So those are the three areas we want to answer your questions. That's why we do this show. It's why we have this channel. So you can send in questions. You can send them in now. Ask Tom, talkmoneywithtom.com. Send them into the chat on the online there if you want to. We'll try to answer those live. We get questions during the week. You can send them also that time. We get questions during our strategy sessions with our clients that we bring up. So hopefully you'll get something good out of what we've got today. And then obviously, the channel's here for you to use. You can go to the channel, you can subscribe, you hit the little bell button, you get notified when new stuff comes on, and we'll be able to keep putting content out that hopefully will help as far as that goes. And of course, you can just meet with us if you want to. 30 minutes with Ethan and I, a phone call in the office, video, whatever works for you. I'll be happy to kind of answer some of your questions that way too. So we believe that the more you know about these areas, even if you have an advisor, kind of the better it goes altogether for you, just in terms of your finances and such. And it's, it's not the only part of retirement. Health is probably much more important than finances, but it is awful nice to have things organized and have things, in the right place and kind of know where you're going. Mm-hmm. Right? I think, a lot of our clients take comfort in that. And that's why we put out this show. It's been, 3 years now we've been doing the show?
Something like that.
So I always start off the show with a conversation, a summary of kind of what I saw happening this week in the stock market and the economy and et cetera. And actually, there's a lot going on this week. Mm-hmm. I mean, the Federal Reserve met this week. We've got some of the more inflation numbers from PCE, the job report today, the job openings report. So there's a lot going on. So we'll talk about some of that and kind of how it affects that. So we'll start here just by looking at the overall chart. This is a weekly data. It just means that, the line is made up of weekly data points for where the market closed at the end of each week. So we can look back farther. It looks back to 2019. We can see the pandemic drop and the big run that happened after that. And so obviously what we're looking at right now in the most current time frame was this kind of straight up line that started at the end of last October, which finally ended in in April last month, when basically the whole month was down for all intents and purposes. But we are seeing a little click upward here, and what I want to do is kind of narrow this down, and let's take a look at hourly data. Okay, so this is just the last 3 months. Mm-hmm. So you can see it's a lot more jagged. It's not as smooth, but there's some pieces in here I want to point out that I think are really important. And some things that are happening right now that could be important. And so, first of all, one of the things we talk about a lot when we're looking at the stock market is what we call primary direction. Yeah. Okay, so this comes from Charles Dow, right? The inventor of the Dow Index, the person that founded and started the Wall Street Journal, right? I mean, this goes back a long ways into the 1880s. And one of the things he talked about was, investing with the primary direction. And he wasn't looking at hourly data, really. They were looking at daily data and such. But there's lots of different pieces that show what the primary direction is if you look at his writings. One of them, and I'll just point this one out because it's kind of simple. Most people can kind of grasp this pretty easily. It's just that you can tell the primary direction by the highs and the lows. And so, for example, when the market is going up, and I put some arrows in here. Here you go. When the market is going up, the lows are higher, right? Mm-hmm. And so you look at the lows when the market's going up, and you look at the highs when the market's going down. So in this case, you can see we've got 1, 2, 3, 4, 5, 6 arrows of green. So kept coming back down, but never got to a new low. It always stopped before it got to the previous low, except for the red arrow that I put in there, right? So that's the first one. So theoretically, that is change of primary direction, and it actually was. It spent most of April there falling. You can kind of see that. And so once you get into this primary direction down, all right, again, this is on an hourly basis. We don't trade hourly basis. Matter of fact, I generally look at primary direction on a weekly data basis, but which makes it, much slower to make changes, but more so a buy and hold concept than a daily trading thing. But just this is a great way to make the point overall, because the patterns are fractal in the market, and so you can look at 1 second data, 1 minute data, 1 hour data, one weekly data. You'll find the same patterns all the
so
way
the
through.
principles apply throughout the different time frames.
Yes. And so now if we look at the downturn, right? Okay, so now we're looking at the highs. So each one of those red arrows, the high attempted to get to a new high, didn't beat the one before. It kept coming down until we finally see that first green arrow there. So that's the first one and that just happened in the last, few days here. And so now, if you look at it, we're in a new primary uptrend. And so that's a big deal. What's important about this is just that when I was looking at the downturn that was happening this week, because we had pretty good sized downturn on Tuesday, I was wearing a red shirt on Tuesday, so it was 1.6%, down 0.3 the next day, right? When on Wednesday, after Chairman Powell actually brought the market down, it was up during, before his Q&A. And I felt like the market was going to be establishing a new low here and then continue back down and quite likely get back down to 4,800. And I talked about that during the weekly, during my daily videos. Just because that's kind of a normal thing. The market had stretched out quite a bit. You have, a huge run that happened for 5 months, and inflation was picking up in the first quarter, and the Federal Reserve was waffling on, when they were going to do rate cuts. And we'll talk more about the Fed here in a minute. But but you got to pay attention to the market. If you just listen to the Fed, or you just listen to the news, or you just look at the economic data, you're going to miss out on what's going on, because the information is in the market. And so there's a reason that it's turning around. There's a reason that it didn't come back down to 4,800. And it might not, actually. This is a nice move here that it's making. And today is basically a green shirt day, right?
Yeah, even though we had those 2 massive down days, the week's pretty much a little bit up for the overall week. That's
right. And so it's kind of a really important support that it's found for itself. Now, usually when you have a 5% downturn, you end up with a 10% downturn, in my opinion, quite often, except when the market's really strong. And the time I remember this happening before was in 2021, and the market basically just kept going and going and going. And we get these 5% downturns. I kept expecting more, and it wouldn't happen. And so I think we're looking at something like that here too, where the market is just quite strong, and there's a lot of interest in coming in when it does get lower. And so there's some catalysts to this, and we'll talk about those. But because we've had some decent earning reports that come out. Google did a big share buyback and dividend, talked about that, and Apple had a big share buyback announcement. There's things that are really kind of driving the market on the earnings side also. But let me switch views here so we can see this a little better. The key thing that the market's really concerned about is inflation for the most part. We're not really talking about recession any longer. And we're talking about, when the Federal Reserve would be lowering rates. And so they came out and said, hey, we don't have confidence to lower. We don't see the confidence at this point to lower rates. And so we think we're going to be up longer, before we cut rates. And they did say a couple things. Number one is they don't expect to raise rates.
Yeah, that's big.
Well, that's actually pretty big. Now, that doesn't mean they won't, right? I mean, but their expectation and what they're seeing, they're not expecting to raise rates, because that would really shock the market, right? And so that's kind of a big deal. But then they also feel that they're going to start cutting back. Right now, they've been dumping bonds off of their balance sheet that they purchased during the pandemic. That is a way of tightening up the money supply of the market by doing that. And they're going to cut back on that activity. So that's their first, that's what they did before. They stopped buying, and then they started tightening, the rates up, right? So they're doing the same thing now. They're going to stop selling some, and then eventually lower rates. So they're moving in the direction. I think, I saw that as quite positive, even though the market ended up down.
Yeah, it's kind of a snail's pace compared to what the market wants.
Yeah, that's true. Was looking for 6 rate cuts at one point this year. That's not going to happen. Although I will say today's action. So this is the jobs report for how many open jobs, and you can see, first of all, if you saw this on a really long-term basis, going back, decades, this is an epic number of open jobs, even now. But this is the lowest we've had now since 2021. So the number of job openings is starting to come back down. And again, that sounds like bad news, but it's actually, unfortunately, in this case, good news, because what's happening is there's too many open jobs. That creates, higher wage demands to kind of get those jobs filled.
Yeah, ideally you want to be 1-to-1 or lower than that.
Yeah.
But right now we have an excess of job openings to the actual people that want to work.
Yeah, exactly right. And it's pretty incredible, kind of what's happening there. But if you're worried about inflation and you're worried about it costing more to go out to eat or to cost more for the different things, then having this come down is a good thing, because it does tend to take some of the pressure off. And then today, of course, we got the jobs report for last month. There was 234,000, I think, was the expected number of jobs, and 175 was the actual number of jobs. And you can see here over the last 12 months that that's relatively low. It's still a good number, actually.
Yeah, you're still growing.
Yes, it's not shrinking like it was during the pandemic or during other recessions. It's still growing, but it's not growing as fast. And so, again, that's just sort of a sign between the number of job openings and the number of new jobs that things slowing down a bit, because the concern is inflation, right? And so if we look at, here's the core PCE, which we got, kind of this week also. This is year over year for the last year, right? And so it's hard to see this, but it's 2.82%. So what that does is means it's looking at, in this case, March of this year versus March of last year. The difference in this basket of goods was 2.8% higher. Okay, they're looking for 2%. We're pretty close. That's not too bad, right? But the problem is what we're seeing month over month. So if I look at this February versus this March, or this March versus this April, for example. And so you can see what's happened here. If we look at the last year, again, on month over month inflation with the same U.S. core PCE, you can see it's up a lot here in this first quarter. And that's why the market's been kind of struggling, because look at how good it was for the previous, portion of that year. Very low, to the point of zero in a couple of those months, essentially. So, however, if we take this back just one step and we go look at the last 3 years, month over month, and then you kind of get more perspective, you can see, first of all, that it does jump up quite often. Even though the inflation's been coming down for most of that 3-year period, you still get these spikes that come up once in a while. And that's what the Federal Reserve has been trying to say. Hey, this isn't such a big deal. This does happen. And I put a little, trend line in there just to say, hey, you can kind of see even then, the month over month spikes are still, trending in the right direction as far as that goes. So, so that's what's happening this week. I actually think there's a lot of positive things with the Fed, starting to ease up on their bond, sales. With the job market kind of cooling off a little bit on both the number of jobs created and the number of open jobs. We've got this short-term primary direction where we're not setting new lows, so we're at least going to get a pretty good bounce here. To truly get into a new primary direction, we need to get into a new all-time high, right? That's what that, and we'll keep on going. Now, on a daily or weekly basis, we're still in a primary direction that's up. I'm just talking about here just the short term, what's happened in the last 4 or 5 weeks. But good time actually. Today's is a great day too. So this is kind of a fun market to be in. I think that this rest that we've had, I would say the price that we're at now, we were at maybe 2 months ago, right? So something in that neighborhood, maybe 6 weeks ago. So at least we've had some time where the market can kind of go sideways, absorb some of these different things, because it gets to be a problem when it stretches out too far and keeps going and going. Actually, that scares me more than a lot of different things, just because what I've seen in the past, what I saw in 2000, for example, it went so far and then it starts to fall, and then it just kind of catches its own momentum and starts to really fall. And all of a sudden you're down 45%. So I'd rather have these little breaks, 5-10% breaks that come along, I think that's the healthier way to make the market. So, nothing we can do about it one way or another, but we can react to them and we can watch for them and we can hope for them.
Yeah, usually these runs, I was looking at a chart and it was showing like 18 to 20 weeks where like kind of those upward runs, and then they had some kind of consolidation period afterwards.
Yep.
And so we kind of hit that point with this one.
Yeah, exactly. And it's been, fun to watch. But things are good in my opinion. All right. Thank you. So let's move on to our first question.
What's a stock buyback and why do companies do it, and why does it push the price of stocks up?
Okay, stock buyback. So, for example, Apple announced, $110 billion stock buyback, and Google, I think, was 70 billion, I believe, was their stock buyback announcement. They're kind of controversial, partly because, that's money that these companies have. And you got to say to yourself, okay, if I have $110 billion, why am I not creating the next great thing, right? Yeah. The next iPhone, or whatever that might be, right? I think the VR goggles, I keep reading headlines saying they're not selling that great, they're that kind of stuff.
It's pretty hard at 3,500.
Yeah, that could be a problem. And so, the reason is because they can make more money, right, for their shareholders by buying back the stock, in their opinion, than they can in inventing something new. Does that make sense? So all of these things are kind of a financial engineering. They're taking a look at what's going on. They say, okay, we've got this 110 billion. Where's the best place for us to put it?
Yep. And
they keep coming back to buy more stock. It's a little concerning, right? I mean, Google, it just shows, because the path of a company is this kind of slow moving thing when it's new, and then it hits this high growth period, right? And it goes straight up, and then it hits maturity where it kind of flattens off in terms of its growth, right? That's the normal little S-curve thing we all saw in finance school. And those companies are kind of hitting that maturity level. You don't really want to think that. You'd love to see Google and Apple, for example, coming up with new products and new things. But what happens is when they buy back shares, they're shrinking the number of shares available.
Yeah, Apple's been doing this for a number of years.
Oh, yeah, for a long time.
They started 2008. Their previous record was 2018 with 100 million, but they also did 75 billion in 2019, 50 in 2020, 90, 21. And so they've been doing it basically every year.
Yeah, exactly. And again, shows how many new products have we seen in that time frame? They dropped the car. We saw these VR goggles. I think that's the only. I mean, there's been improvements on their existing pieces, but they're no longer that earth-shattering, coming up with things that people the iPhone that they did. The smartphone really is incredible. They don't have Steve Jobs anymore, and so that's part of the problem, obviously. But when you do the numbers, if you reduce the number of shares, right, and the demand, if it just happens to stay the same, you would start to see an increase in price, right? Mm-hmm. And if you have the same amount of earnings and you're dividing it by less shares because you purchased shares and took them off the market, your earnings per share is also going up.
So you're fixing your financial ratios in a sense.
Yes, and this is financial engineering, pure and simple. They can, the thing that I think, I have a finance degree, and one of the things that always kind of struck me about this was that over and over and over again in the classes, in the textbooks and what have you, the job of the CEO and the CFO, Chief Financial Officer, was to increase the price per share. Their job was to serve the shareholders, period. Well, there's some huge problems with that because, theoretically I might be able to increase the price per share by dumping toxic chemicals into a river instead of properly paying to have them disposed or whatever, right? And so that's one of the problems. All of these CEOs and CFOs that are coming out of these business schools and these finance degree schools are learning, something that is probably pretty controversial. But this financial engineering that goes around share buybacks has to do with this. It is, you're looking to increase the price of the share, period. Mm-hmm. And so if I have $110 billion, I can very much so figure out what that means and how much I'm going to be increasing the share price. There's market forces, the market falls apart, there's all kinds of things that can happen because it's kind of like a tide, with boats going up and down, and you could be buying back shares and the price is dropping because the whole market's hitting the skids.
Mhm.
Eventually, when the market comes around, theoretically, you could come back even faster with less shares. But so you're just reducing the number of shares that you have on hand, and it'll increase the potentially the price and increase the earnings per share. So um, I don't know what to think about it. I'd much rather see companies coming up with new products, especially companies I really like, they think can do some fantastic things. It would have been really interesting to see the Apple car, to be honest. It would have been kind of fascinating,
Mhm.
whatever it would have been. I'd rather see them spending that money there as a shareholder, than having them buy back shares. But the market likes it because it knows what's happening there too. And
Yeah.
Wall Street is kind of short term based, quarter by quarter, to be honest, more so than what the future might happen. And I think that's one of the problems. Like Meta's been having. Zuckerberg keeps talking about these longer term dreams of what he sees happening.
Yeah, in the 5-year plan or a 10-year plan.
Yeah, and because he's the visionary. It's his job, right? When he starts talking about the metaverse, they hammer his stock,
Yeah.
because they want to know about next quarter more than anything. So it's kind of interesting, but that's what buybacks are and how they work.
Would delaying my savings or investment rate to help pay for my child's undergraduate be financial suicide?
Yeah, financial suicide. Uh, all right, so I'm saving, whatever for retirement. It's the age-old question of, do I save for retirement or do I pay for my kids' college, right?
Yeah,
In essence.
general wisdom is that just like an airplane, you always put on your mask first, and then you put the kid's mask second.
Yeah, I find that difficult to deal with only because I mean, you chose to have children. They get into some great school that happens to be expensive. Do you, say no to them and change their future because of your, retirement needs? That's a tough one. I would struggle with saying that that was the right way to go. Financially, yes, it makes some sense when you look at, the overall cost of what you're doing. It's not just the cost of that school. It's what that money would have been worth to you,
Later
10,
on.
20, 30 years later, right? And you see these Susie Orman and what have you running around talking about, you've got to pay yourself first and put your own mask on first and what have you. But in real life, uh, you know, I think it's important to be able to let that child reach their potential,
Yeah,
right?
and this question's we can't really answer that question,
You're right.
honestly. There's so many variables that are there. You know, is this kind of like, oh, I saved for them to go to state school and I have enough money for them to go to state school, but they got into their dream private school, and now how am I going to make that work financially?
Right.
Or is it like I'm only short $5,000 a year and I make $120,000, and so like it's kind of knowing what inputs you have and what outputs you want to kind of get.
Yeah, that's one of the problems with this show. Actually, we get these questions, and they're good questions, but really to do the right answer, we would do a plan,
Yeah.
and we would get into the details of exactly what that meant. And because how much impact is it really? Is like you said, it could be very minor, or it could be very major. You know, it's a tough one. This happens all the time where people can't go to the school that they want to go to because they can't afford it, right? I do. There was one thing you and I were talking about before the show is having the kids pay for 1 year
Hmm.
of that. Is kind of an interesting idea. So that would kind of split the difference a little bit, so you wouldn't have to spend as much. And maybe, I was thinking about, a scenario where you've got a student that's fully involved in school. How can they possibly pay, make enough money, right,
Yeah.
to pay for one of the years, especially at an expensive school?
Yeah, so there's options. You can take on some debt.
Mhm.
Student loans are quite common, and they're sadly very easy to get. Even so, it's a thought process: is how much is my degree going to be worth for me? So it's kind of brutal to say that not every degree is worth the cost.
Yeah, yeah,
But you have to sometimes think about the return on investment. Is this worthwhile for me to go to the school, or is my child? And it's a conversation you should have at least. Have that kind of concept, or
mm,
because everything in life is kind of, in a sense, an opportunity cost. If I go pay this much money, this is a cost, and am I going to get more back for it?
yeah. I think the child takes out a student loan to pay for that 1 year, right? Maybe you cover the interest while they're still in school or something, and then they get out of school, they get a job, and now they're paying that off. It gives them a vested interest in that degree. It takes some of the pressure off of you. You're paying for 3 years instead of 4, right? So maybe that means that you can put more of that money towards your retirement instead of paying for the whole thing. It's not always great to have a child come out with some debt, but it's not always that bad either. I mean, it's they're paying for their education.
And they have a vested interest.
Yeah.
If you, because unfortunately, like if you go to art school, you could be a great artist, but the odds of making it out and becoming a wealthy or having to be able to afford a lot of, being the best artist out there to be a profitable artist is tough.
Yeah, exactly. So it's a good question. Kind of depends on some of the details, but there's a lot of different thoughts and ways to do things. And so again, that's where, consulting with somebody like us, I think would be worthwhile in a scenario like that, just to, what ideas do we have? And we've learned a lot from, all the experiences that we've seen our clients put their kids through college and how that's worked.
Yeah, and there's also degrees where, in theory, you could get discharge of that debt too. And so if they go into a degree with they can discharge it, and you feel they're going to be in that degree long enough to have that debt discharged, maybe you allow them to take on a little bit more.
Yeah, that's good. All right. What's our next question?
Can you use a home equity line of credit as an emergency fund, so a HELOC?
Okay, home equity line of credit, just so you know, there's this first mortgage that we're all familiar with, it's a 30-year mortgage and whatever. Home equity credit line is basically like they open up a checking account against your house for all intents and purposes.
You have.
And some of the equity, there's some limit to how much you can do. There's different types of them in terms of what interest. They're mostly variable interest, where it goes up and down with the interest rates, that kind of stuff that's happening. And so theoretically, you could go into your retirement, and I actually advocate this, with a home equity credit line available.
Yeah.
But it shouldn't be your emergency fund in the strictest sense. An emergency fund is money that you can get to right now that doesn't cost you anything. It's money in the bank, right? Yeah. It can enhance the overall concept of how much money you have available in the event of some emergency.
Yeah, you might be able to have a slightly smaller emergency fund because you're adding like another layer of defense.
Right. I mean, I've seen, from $10,000 to $1 million in cash be the need for each of the clients. It's variable, depends on the person. I know there's rules of thumb, but nobody follows those rules of thumb. It really comes down to kind of how you feel. So whatever cash you have in the bank, you could then have another few $100,000, $500,000, whatever, set up already, and I would do that prior to retirement if I could, just because it's easier. The banks really like it when you have income from a job, more so than income from investments. But, then you could say, hey, I have this money in the bank, plus I have this HELOC. That makes it a bigger emergency, but just to have it as your only emergency. The reason being is because in 2008, when everything started falling apart for the banking system, quite a few banks said, okay, whatever HELOC you haven't used is gone.
Yeah, you're just cutting you off.
To cut you off. It was not, didn't have to pay anything, but if that was your emergency fund, it just disappeared in a time where the market's falling 57%. So I would say that you'd want to have money in the bank, especially below $250,000 at each institution, just in case. But there was even some stories of forced payback on some of these. That was more rare, but that would be one of the problems, to rely upon that solely as your emergency fund.
Yeah, and you're getting charged an interest rate. No matter what you do, you're paying a fee for this money, essentially.
Yeah, not if you're not using it, obviously, if it's just sitting there.
Yeah,
but if you're
withdraw.
using it. Yep, exactly. And the rates have come up a bunch, of course, because the interest rates are higher now than they were. Yeah. All right.
So what are your thoughts on downside protected ETFs, or ETFs with kind of like a buffer? So they have maybe recently this week one came out with 100% downside protection. So basically they have a fixed point, anything below that you're protected. And then a buffer system is the market drop 20% from their whatever starting point, and then you start to take losses after that 20% down.
Yeah, so it's kind of it's a long-term strategy. I don't like it because they have all kinds of caps on the upside,
Hmm.
and uh, they're expensive, right? I mean, the
Yeah.
internal fees are high. Um, However, it is interesting, and we were talking about this today. So if you have a rotational strategy like we do, basically where we have this big list of curated ETFs, and we're looking for momentum, and
Hmm.
all of a sudden all the stuff that's moving to the top is like the T-bills and what
Yeah.
have you. And so you're kind of moving in the market, and the one problem with that is that the market turns around really quickly. Like for example, November market was up 8.9% last year, right? You could miss a lot of motion very easily. Matter of fact, that's the common thing. And so the advantage of is kind of splitting the difference. You could have a downside buffered ETF,
Yeah.
right? That you move to instead of that T-bill or what have you. That way, when the market does jump, you're capturing some, or like some of the caps are, let's say 9% and a quarter or whatever it might be,
Yeah.
right? So that'd be nice to capture that versus the T-bill, which is not capturing it at all,
Yeah,
right?
so if you're not, if you can do it for a short-term strategy where you move in and out, there's some utility for that.
Yeah, I think there is some utility there, just in terms of being able to use it for a short term, sitting spot where you could go into that and then wait, and then market takes off, and you're still capturing some of that upward motion.
Yeah.
Now, you got to be really careful, and I'll bring this up because I get a lot of clients that ask me about things, and they're really looking at short term, moves like what we just had, this 5% type of thing. Well, could we have done this or that, at the top or what have you? And the answer is no, because if you really look at, at least in my opinion,
Hmm.
when we really look at the data and you really look at the back testing of all of these different systems, I haven't been able to find anything that works for short-term moves.
Short-term moves are very hard to
They're brutal.
be constantly correct on.
Yeah, you shouldn't be messing with those. You should be in a longer term horizon. That's where kind of the sweeter spot has been, and we've had some success, something that will develop for 3 months, 6 months, a year, 2 years. That is much more what you want to be concerned with. And you're really trying to take out, it's sort of like having a high deductible, on an insurance policy. It's like, okay, I can afford the first 20,000, but I want to make sure if I
I'm
get
not
a
getting
really,
100,000.
yeah, I get something really big. And so, that's what we want to avoid in retirement, are these really big downturns that go on forever. The 87, not 87, that was a one day thing, but the 2008, 2000 downturn, for example. Even the 2020, although that one was really short in the end,
It's very
it was
quick.
very weird, but very, very dramatic and so fast to the downside. And that's anyway. So I think that's an interesting strategy. The downside protected ETFs. It's something we're going to be looking at as far as that goes. Again, you have to be careful. Sometimes these things break.
Yeah.
Yeah, and so I'd have to be convinced if I was looking at that as a downside protection that they don't break, because I feel very, very confident in a T-bill,
Yeah.
And so does that thing actually hold that downside protection when everything is falling apart?
And then how does the downside protection work?
That's exactly
What
it.
is that starting point?
Yeah, so I don't know all the details actually yet. These are relatively new. Um,
It's an interesting tool.
it's
And
worth looking at.
you can kind of think of it as a specialized tool in your tool belt.
Yep. Yep.
It's not going to work for everything. You're not going to use a screwdriver, a hammer, and a nail. You can if you want to, but it's better to use a hammer. And so maybe this has a place.
And like anything, it's a portion of what you do. Keep
Hmm.
yourself diversified. Don't put all of your money into those things when the market's falling apart in case they do fail.
Yeah.
Use either stay in and ride it through, or move into other things, more defensive stocks like utilities or something that generally fall less, or move into T-bills, whatever it might be, and have a variety of different things that kind of gives you, more options for things to go right.
Yeah.
Right. Instead of one option that if it goes wrong, you're in trouble. Yeah.
So why does the market react so differently to different earnings calls? For example, Tesla, Apple, Netflix earnings calls, some of them were quite positive, some were quite negative, and the those stocks fluctuated massively.
Yeah, let's think about that. So Tesla, I think they were up about 15% the next day. Apple, last time I looked, was up almost 7% today. Netflix was down. I want to say like 12%. I can't remember for sure.
Yeah, something like that. It was a big loss.
And so why would Netflix, which had good numbers, right?
Yeah, good earnings.
Good earnings. They beat expectations and what have you. Why is Netflix down and those other two are up so much, right? One of the things you have to be cognizant of is that, the market is a representation of human emotion. Mm-hmm. Never forget that. If you keep saying that to yourself, it'll make more sense. And humans get in moods, right?
Yep.
Happy, sad, depressed, whatever it might be. And so if you look at when Netflix came out, I think their earnings were right in the middle of this downturn that we were having in April.
Yeah, they were about, I think the 18th or 17th.
Yeah, which is right around the low, actually. And so the market's in a bad mood. It's falling. It's falling because inflation's coming up. And, and then you come out and you have a report and you have good numbers, but then you make, a less than expected future forecast. Yeah. And they pound you 12%. Now, you have that same exact report when the market's in a good mood. I think it's in a better mood right now. Yeah. You come out, if Netflix was reporting today, I bet you it doesn't drop 12%.
Yeah. Probably.
So that is part of it. You do need to watch. Now, the other part is, what are they actually saying? So for Tesla, for example, they had talked about abandoning the inexpensive Model 2 that they've been talking about for quite a while, which a lot of people are thinking is a really big deal. You know,
that's going to be their big, gain market share and everything.
Yeah, that's where they could get critical mass. In essence, right? You get some $25,000-$30,000, Tesla that still works pretty well, and whoosh, it really, opens the door to a lot more people. And then those people, if they like it, might move up amongst their cars, right? And all this type of stuff. So they took that away, and the stock fell. If you look at the chart, after they announced their earnings, as they were announcing it, they talked about actually reintroducing that concept. They looking at, after the market reacted, I think, quite negatively, and analysts reacted negatively, they said, okay, we're still going to do it.
Yeah, they basically said they're doing it a little bit faster.
Even faster, yeah, that's kind of amazing. So, but the stock just kind of moved back to where it was before they started talking about not doing it.
Yeah. There was expectation Tesla's earnings were going to be bad.
Yes.
And so it was
and
kind of...
They were down, 55%.
Yeah. But people were pricing that in.
Yes.
So the essence is, what is people pricing in, and what's the future guidance? And so they have to adjust the price to the future prediction.
Right. Yeah, exactly. And so, Apple comes out, and again, they had better revenues and earnings. They were down, right? But not down as much as expected. So the market has to move back up with this new reality, right? So, hey, we dropped the stock 10% based on, hey, the earnings are going to fall this much and revenues are going to fall this much. And when they don't, then the market readjusts itself. Mm-hmm. And then, they talk about a bigger share buyback, and that might not have been in the expectations and those types of things. So, and at the same time, the market's in a better mood right now than it was with Netflix. So that's kind of the differentials, that you see on how these things work. I wouldn't pay too much attention to these shorter term moves, personally. If the company's still sound, like Netflix, give a good example, if they have softer projections going forward, it just makes it easier for them to jump over that and for people to get excited about it. So that's not all bad thing. It's just, what's their overall model? Is it working? Are they having good growth? Netflix is actually doing pretty well. They're starting to have a lot of original content that is really seems to be driving people, because there was a huge fear for a while Netflix was going to basically disappear when all these other streaming services picked up with Apple and Paramount and et cetera. That hasn't been true. I think they answered that call pretty well.
And also the restricting of password sharing has been a very big
that's a big
boost to their revenue.
Yep.
And you can see a lot of other streaming sites are kind of taking their lead and following through with that too.
Yeah, that's worked out quite well for them. There's some. I think there's I wouldn't worry so much about Netflix's situation from that one earnings call or from that one day, as much as I would worry about what's the long-term look for Netflix, and how do I do I want to participate in that or not, or do I want to be in something else, right? So I think that's important. All right, so we have time maybe for one more.
What's a life estate and a remainder interest?
Life estate and a remainder interest. Okay, so let's say that you've remarried and you already have kids. And so you've got this spouse, maybe you're living in your home.
Yeah.
Okay. And you want to make sure that your spouse can still live in that house for as long as they live, but you want the value of that home to go to your children, the remainder estate to go to your children. So what you can do in your trust is you can give a lifetime interest to your spouse for that house. They could put all kinds of things in there. Maybe they're responsible for the upkeep and some expectations so they're not
Just
running the
trash in
house
place,
into the
yeah.
ground. I've even seen where money is set aside for the maintenance and cost of that house, and anything that was left over would then obviously be going to the kids also. And so that's called lifetime interest with remainder. So basically the remainder is going to your beneficiaries, and let's say in this case your kids from your first marriage, et cetera.
Yeah. Another common one is when you're taking care of your elderly parents, you could give them a lifetime interest in a house that you own.
Yeah.
And then the house gets returned to you essentially when they pass.
Yep.
Or your estate.
Yeah, exactly. So that's that. It's just basically a contract. It's spelled out in your trust. I've seen it in trust, so you might be able to do it in a will. I'm not an attorney, but I've seen this in trust mostly and documented. And so it's something that's not super uncommon.
It's very efficient because the idea is that you still control where your asset goes. After your spouse, you take care of you achieve your goals in a sense. You take care of your spouse, you give them a place to live if it's with a house, and then you still allow your beneficiaries to gain access to that asset.
Yep. All right, that's our show for the week. Looking forward to being able to see you again next week, right? Send your questions in now. Give us a chance to make a nice chart for it or find out some additional information. Obviously, you can use our email address that's on the screen here. Ask Tom at talkmoneywithtom.com. Obviously, the next thing is, subscribe to our channel, continue your education, hit the bell so you get notified when new stuff comes out, right? Just continue to learn about some of these things. You can see there's a lot to learn. There's a lot of, we've been doing this show for a long time. We're still answering different questions over and over and over again. There's a tremendous amount of things that are important to know about. And then, of course, you can meet with us if you want to, up your education even faster. Just, come in and talk to us. You can come face-to-face, phone, video, whatever works for you. You can schedule that appointment right on our website. There's a button that looks just like that on the website. The website link is here on the channel too. Our schedule is live. You can go find a time that works for us and set it up. So look forward to being able to see you guys again next week. Thank you for joining us today.